What's up, agency owners? Jason Swenk here with another episode of the Smart Agency Masterclass, a podcast for the digital agency owner that wants to scale faster, but also have the freedom to pick and choose to do the things that they love doing. And on today's show, I have an amazing guest where we're going to talk about agency benchmarks when we talk about kind of financial and what we need to be paying attention to. How can we improve it so we can actually scale our agency and get to where we're wanting to go? So let's go ahead and jump in. Hey, Chris, welcome to the show.
Appreciate that, Jason. Thanks for having me.
Yeah, man. Tell us who you are and what do you do?
Sure. So my name is Chris Hervochon, and I am from Hilton Head, South Carolina. And I run a CPA firm that specializes in virtual CFO services for agencies. And we've got a team of 8 spread all across the U.S., and we've got a client base that's spread all across the U.S. as well.
That's great. Well, let's talk about when it comes to the finances of an agency, what's the biggest screw up that you see?
Holy cow. How long's the show?
Just pick the top one.
Yeah, so the top one is going to be cash management and just understanding how that works and how all of those things interplay. So understanding how cash moves into and out of the agency, how it's going to move into and out of the agency. So that's looking, toward the future, how that's impacted by your clients and the work that you do for them and how you collect payments, and then how that's going to impact the people that you pay who work in the agency or for the agency, and how you're going to scale up. So how you're going to bring on the next hire and things like that.
What are some key metrics that we need to be paying attention to when it comes to, I always tell our mastermind members, what are the KPIs that you need to know about if you are on top of a mountain, hiking it, and you just want to make sure the agency was running well? What would be yours that you would pick?
Sure. So I'll give you a couple. Profitability, especially on the net side. And where we want to see you is north of 15% or sure. We would consider north of 20% to be good. At 15% or less, that's when the alarm bells start ringing and we need to start pulling some levers and figuring out exactly what that is. So net margin, that's going to be net income. If you're using some sort of an accounting software, if you're looking at a P&L, net income, that's your bottom line. Okay. The other thing would be gross margin and how you define that in your agency. So gross margin is going to vary wildly across agencies, and it varies wildly across our clients. Every agency operates differently. So in that particular case, you want to be looking at yourself versus yourself and tracking that over time, making sure that you're maintaining or increasing margins over time. So that would be another one.
Well, let's stop there. I have a question on gross margin. A lot of people may be thinking who cares about gross margin? I only care about net margin. So tell us a little bit why we should be paying attention to gross margin.
Okay, good question. So the way that we define gross margin would be revenue less variable expenses. Variable expenses can otherwise be called COGS. If you're using QuickBooks, it's only going to be called COGS. Cost of sales would be another term for it. But basically what it is the percentage of revenue that you can keep in order to pay fixed expenses and then to pay yourself. So they're all variable costs. They're the costs that you are going to incur every time that you generate $1 of revenue.
Got it. And why do people care about that versus just looking at, net margins?
Right. So if your margins are super low, it's going to be really hard to pay your fixed expenses. Really good examples of fixed expenses are going to be your people and rent, things like that, software costs, the things that you really need to operate the agency and deliver your service. So if you don't have enough money left over to pay them, now you've got to start making some weird decisions. Like, what do we do? Cut headcount? Do we cut the different types of expenses, the different types of software? And then at that point, you probably don't have any left over to pay the agency owner or owners. And that's a problem unto itself, obviously. Like, this isn't a hobby, it's a job. So you need to be paying attention to margins and making sure that you have enough money every time that you generate $1 of revenue so that you can pay all of those expenses. Having revenue is cool, But if it's not actually going to add anything to your bottom line, and if it's not actually going to allow you to pay your fixed expenses, then there's really no point in bringing on that revenue.
What are ways that you've seen um, work for agencies to increase the margins?
That's a good question. Um, Pricing is always going to be the biggest lever in how you price. Um, it's difficult, obviously, especially in a weird economic time. So, but um, that's going to be your biggest one. That's your biggest opportunity. That's the way that you can move the needle, and the way that you can increase prices is by building the value, having the value conversations. Number one. Number two, making sure that whoever's doing your sales and is doing your pricing, making sure that those two functions are split. That's another one. But pricing and how you price and how you sell and making sure that you're building up the value so that you don't get the pushback from the client or potential clients. That's a big one. When you're looking at expenses, it depends on how you operate. So if you're an agency where most of the production is being done by an in-house team, that's not going to be an option on the gross margin side. There's always an opportunity, or not always, but there can be an opportunity maybe to flip some inside capacity to external capacity. So leveraging contractors insofar as it's going to be beneficial and a lower cost than bringing on a full-time employee and all the things that come with that, benefits, taxes, managing that employee, that sort of thing. And then looking at production type software. So what do we really need? How can we save money on that? Are there things that we have in the agency that maybe they're duplicative? Taking stock of who's using what, that sort of stuff. Those are probably the most common tactics that we see.
What are some ways, I always tell agency owners, and especially the ones that I'm working with in the mastermind, is like, you have to pay yourself well. And stop like paying yourself 2 cents just to tell people that you're 30% profitability, especially if you're trying to gear up to sell it one day or have the opportunity to sell it, because a buyer is going to come in and look, hey, you're still, like your margins are this. You're just not paying yourself. Like if I had to bring someone in, this is what I would pay them. So the real question is what are you seeing on average? Like what's the percentage or what's the average salary of an owner in, let's do two brackets, an agency under $1 million in revenue and an agency over $1 million in revenue? What's just an average that you're seeing?
Yeah, so good question. The way that we tackle this, because we also do tax planning, and the vast majority of our agency clients are S corps, so we're doing reasonable compensation studies. And the way that we go through that, we use a software tool, and basically what it does is we take all of your functions inside of the agency, we figure out how proficient you are at those, we assign a rate to each hour of that time, and it's based on Bureau of Labor Statistics data. We add it up, and then that's what you pay yourself in payroll. So that satisfies the IRS. The reason why we do that is we want your pay to be as low as possible to save you the most taxes, and then the rest of your compensation we're taking out as a draw, right?
Mm-hmm.
So when you're going to sell the agency, what the buyer should be looking at, and probably is going to look at, is how much cash is this agency going to kick off. So if your compensation is unreasonably low, they're going to adjust your compensation and say, well, if we had to replace you tomorrow, we're not going to pay somebody 50 grand. We're actually going to pay them 100 grand or 150 grand or whatever it is. So they'll adjust it. Now, when we go through this salary survey, theoretically, we're going to get you to the point where that's apples to apples, right? So whatever it is that you're taking out, that's what that potential buyer is going to be looking at, and there's not going to be any sort of adjustment, and so we're good. Now, what we're seeing on the draw side, which makes up the other component of how much an agency owner is making, like I said, we want to be north of 15% for sure. And then it's going to depend on how much money you can take out of the business. So you want to make sure that you've got an adequate cash reserve, something to get you through difficult times. You're going to want to make sure that you've got enough cash to adequately invest in the agency. So maybe you got a plan for headcount. Maybe you got a plan to replace everybody's MacBook. Maybe you got a plan for a new office space, that sort of stuff. So it really depends on how much you can take out. But the place where we start as far as agency owner compensation is that study. So it's a balancing act between what you should be making and then, how we can kind of plan for taxes and things like that.
So so for some people listening, if they're, let's just say right under the million, let's say there are 750,000, one scenario. What's an average that you're seeing for the agencies you work with the dividends or the distributions and the salary together? What would that be? Like I remember what I was making around that time, and I think it was 150,000 a
Yeah.
year. That counted for everything. Like, what's the average that you're seeing now?
Yeah. So most owners where we're doing comp surveys for, they're going to be somewhere between, I want to say it's 80 on the low end and 120 on the higher end. And then if you take 15% of the remaining call it 750, that's going to be another 100 and about 110. So you're probably looking somewhere in the 175 to 225 range for an agency that's operating profitably and running a good business. And, you've got a talented individual who's running the agency. I would say somewhere in that range.
And then what about, let's say, around the 3 million mark, right? Of kind of gross for the agency. What I just want to give people a number to shoot for of going, hey, you're paying yourself too low, or maybe you're putting too much in your pocket and you should be reinvesting, some into the agency.
hmm Yeah, when you're starting to scale to that size, your cash reserve needs to be a lot higher. You've got a lot more people. You've got a lot more fixed expense for sure. But if you're just using those rough numbers, your salary wouldn't necessarily increase by whatever that's going to be, 4x. Your salary is going to be roughly the same. And again, part of the reason why we do that is for a tax benefit. We want you to be taking more distributions than more salary. Salary is the most expensive money that you can get from the agency. So, if you're, that 20% range on 3 million, that's 600,000. You've got another, call it 100,000 in payroll. That's going to be seven. You're probably going to have to invest some in the business. So you're probably, north of a 500,000, something like that.
Okay, good. Yeah, I just want people to realize that. Yeah, and when I say kind of, I should probably just say compensation.
Yes.
Where people can go after, because I know the tax man of what they take, and you want to pay them as low as possible. Um, let's kind of turn it on a benchmark of, cash flow is everything,
Yep.
and you need to have cash flow in order. I mean, it's like blood going through your body. How much? And like we were talking to our community the other day, and I was saying, what do people have in cash reserves that they feel safe with, and what is the kind of the alert, like alarms going off? I need to do something. What are you seeing with how many months, or in some instances, I cringe when they say years. I'm like, oh my
Oh
god, like,
no.
yeah.
Yeah.
What's a benchmark for cash flow that you're seeing that a good agency can kind of model?
Sure. So we want you somewhere between 2 and 6 months of fixed expenses in cash reserve. The way that we calculate fixed expenses is basically we just take your last 3 months, average it out. And then again, fixed expenses is going to be payroll, rent, software subscriptions. Those are your biggest ones. So average of 3 months and then somewhere between 2 and 6 months. Then the question is, well, should it be two or should it be six? And then the way that we determine that, because that's a quantitative thing, but we do it with a qualitative survey. So we have 8 or 9 questions that we ask, and then we ask our agency owners, like, rank it on a scale of 1 to 5, take the average of that. And it's things like, how good are you at AR? Do you have zero AR, meaning you're getting paid upfront, retainer based for everything? So you're a 5. It's awesome. Or, like, in some cases, believe it or not, they will say, well, I don't even know who owes me what. Right? You are just, yep, that happens. So you're decidedly in the 1. Okay. So it's questions like that. How much investment, do you have to make in the agency? How are you going to scale? Stuff like that. And where we're seeing agency owners land usually is going to be somewhere in the 3.5 to 4.5 month range. Usually, I have yet to see anybody who's got to be in that 6 month range, and I've got yet to see anybody who's going to be in that 2 month range. But that's generally where we're seeing people land.
Yeah, I was always around the 3 month mark.
Hmm.
is what we wanted. And then anything over the 3 months, I wanted to reinvest and put
Yeah.
that back in. And one thing too, I want to tell everybody, when we're mentioning profit, and I mentioned on the show a lot of times, the average that I see, in the mastermind is over 25%. Professional services around 30%. And then some people go, oh, I'm at the 15 or I'm at the 18, I suck. What you got to think about is it doesn't matter what that profitability is until you get closer to the end goal. Like if you're wanting to sell one day, then you should get to that goal. But if you're reinvesting into the agency, and this is for building the business even bigger, you're fine to dip below that. You just don't
Hmm.
want to go below that too long. It's kind of like holding your breath a little bit. Why do you want to run a business that's losing money? But if you're investing in some particular process or system or something that's going to get you to the next level, do it. But you have to, project that out. What's the best way that you've seen agencies kind of project out an investment into the future?
Yeah. So usually that's going to mean capacity. Usually, so people cost, and then there's some cost that comes with that. You're going to have increased software subscriptions. You're going to have equipment costs. You may or may not need a bigger office. That sort of stuff. The best way to do that is to put together some sort of a capacity model and figure out we're going to need these roles for this amount of work, and they're likely to cost us this. And the way that you figure that out is you do a compensation study, which can be as simple as just going on Indeed and figuring out the roles that you need to hire and what their market rates are right now. Obviously, you need to update that on a consistent basis, especially during these times. But figure out who you're going to need and what you're going to need, and then figure out what costs go along with them. So, benefits, taxes, equipment, software, all that stuff. Project that out into the future, and then look at what that's going to do to your cash flow. Um, we from a cash flow perspective, we're forecasting out for our clients 6 months. Longer than that gets very, very difficult. And then from a full financial perspective, we're looking out a year. So we're forecasting the whole P&L going out a year.
Yeah, we would basically export out into a spreadsheet form kind of all our expenses, from the prior year, and then we'd go,
Hmm.
okay, let's model this for another year, and then just start adding in all the other ones, and then assuming that if you've had 10% growth or 20% growth or whatever it is, you put that, and then we were able to kind of project out and even throw in kind of pipeline and the percentage, and we could literally accurately kind of go, well, in 8 months we're fucked. But we had 8 months in order to do that, rather than, I remember I got to a point where I came in a management meeting one time, and we were doing kind of budgeting by just looking at the bank account, which is not
Oh,
something I would
geez.
recommend, and going, oh my God, we're not going to be able to do payroll in 2 weeks. And then from that, I just remember that pain that I went through, and the worry of not being able to make payroll. We were able to make it, but it was a stressful time. And then we started doing that modeling and performas and all that, and it just made life so much easier, because then we could go, all right, we got 8 months to make a course correction, and everything always worked out. Obviously, it worked out. So
Yeah, you have to do the forecasting because the forecasting is going to tell you when you got a problem before you have a problem. You don't want to have the problem and have it be like today's problem, and you don't even have the opportunity to plan for it or make any sort of course corrections. That's how really bad things happen.
yeah. Well, this has all been amazing. Chris, is there anything I didn't ask you that you think would benefit the listener listening in?
Uh, the last two metrics.
Go for it.
Yeah. So one was the cash reserves, and then the other one was pipeline. Measure your pipeline. Have a process to measure your pipeline, because your pipeline that's going to feed into your forecast, and it's also going to tell you who you need to hire, when you need to hire, when you need to fire, who you need to fire, that sort of stuff. Measuring your pipeline. That's probably one of the other KPIs that I would say you should look at.
Cool. And there's one more?
The other one was cash reserves, and we
Oh,
just
cash
touched on
reserves.
that.
Okay, cool.
Yep.
Great. Awesome. Well, and what's the CPA website? People can
CPA
go and check you
website.
guys out.
Yeah, so betterwaycpa.com. We've got a whole bunch of resources on there, webinars you can go download and view on demand, ebooks, all that good stuff. So a whole bunch of information out there.
Awesome. Well, go check that out. And thanks so much for coming on the show. And if you guys are listening and you're struggling to scale because maybe you've hit that plateau and you just don't know what you don't know, whether, from bringing on more leads, hiring the right talent, really raising your prices, or really optimizing your day-to-day ops, I want to tell all of you to go to jasonswank.com/game plan. And I want you to book this game plan where we can look at your business and we can figure out a way together in order to scale your agency faster. So make sure you go to jasonswank.com/game plan. And until next time, have a swank day.